There's little to no return for holding cash in a checking account, and cash invested in money market accounts yields a low return. Yet some companies have significant cash balances. Why do companies hold cash if the return on holding cash is so low? There are several reasons for holding cash: to meet the day-to-day needs of the business, to prepare for random shocks, to comply with bank requirements, and to avoid the hassle of transferring funds between hundreds of accounts. Let's start with the day-to-day needs of the business. Some cash is needed to pay the everyday bills of running a business. Companies need to pay utilities, rent, employees, contractors, insurance premiums. Thus, companies need to make sure there's some cash on hand at all times to make these payments. The amount companies need for paying bills is called the transactions balance, and this amount is based on the size of the company's bills and the length of the company's cash conversion cycle. The longer the cash conversion cycle, the more cash the company will need to keep on hand to pay its bills. But companies also need to keep cash on hand to prepare for random shocks. Uncertainty about future cash needs is inevitable, as all companies face the possibility that some random, unforeseen event will require cash. Thus, it's helpful to have some cash on hand to weather these random shocks, and that cash is called the precautionary balance. The more uncertainty there is, the more cash should be kept on hand. Another reason to keep cash on hand is to comply with bank requirements. Many banks offer free checking and other services if companies agree to keep a certain level of cash in the bank. This is called a compensating balance, and companies might be subject to a service charge if their balance falls below this threshold. Yet another reason for holding cash is to avoid the hassle of transferring funds between accounts. A large multinational firm might have hundreds of accounts across multiple banks, and it can be very time-consuming transferring idle cash between these accounts. At decentralized companies, for example, different business units or subsidiaries will have their own bank balances. Thus, some cash will inevitably sit idle because it isn't worth the hassle of transferring it to another account and investing it. So how do you optimize cash management? Well, executives should strive to create a cash management culture. This includes creating a cash committee, tracking and increasing the visibility of KPIs for working capital and cash flow, tying executive compensation to working capital and cash flow metrics, investing excess cash, and centralizing the cash management function. Creating a cash management culture requires buy-in and coordination from employees across the organization. To increase the chance of achieving this, the company can create a cash committee with representatives from the sales, production, procurement, and finance teams. Moreover, executives should closely monitor working capital and cash flow KPIs to identify problematic trends. Management should be responsible for these metrics, and their compensation should be at least in part based on achieving working capital and cash flow goals. Excess cash not needed for day-to-day operations should be invested in low-risk, short-term investments to earn a return. These types of investments include treasury bills, CDs, commercial paper, and money market accounts. For decentralized firms where each subsidiary has its own cash, centralized cash management can ensure that excess cash is invested and that you don't have one subsidiary borrowing money at 12% while another subsidiary is investing cash to earn 3%. While a subsidiary needs its own bank account to have true operating autonomy, the parent company need not allow each subsidiary to manage its own excess cash. One alternative for multinational firms with subsidiaries in different countries is to use a regional system in which cash from banks in each country is transferred into a multi-currency account in a central location. Money can then be transferred from the main bank to local banks in various countries as money is needed. Another alternative is to use a multinational bank with branches in each country and to have the bank pool the surpluses and shortages across the various accounts. This eliminates the need to transfer funds between accounts. Here's a summary of best practices for optimizing cash management. If you'd like to receive the PDF guides I've created on each of these topics, you can sign up for my email list using the link in the description section below. You can also access the PDF guides immediately by becoming a supporter on Patreon.